Your 30s are weird. You're not figuring it out anymore, but you're also not fully secure. One day you feel established. Steady paycheck, real job title, maybe even a 401k. The next day, you're Googling things like, how much house can I actually afford? Am I behind on retirement? Why does daycare cost more than college? This is the decade where money stops being theoretical and starts becoming structural. Your 20s were about experiments. Your 30s are about foundations. And the financial decisions you make during this decade, they quietly decide whether your 40s feel powerful or pressured. If you're new here, welcome. On this channel, we break down real-world money strategies without the fluff, the hype, or the shame. If this video helps you think clearer about your finances, hit subscribe and let's build this right. Now, before we dive in, this is not about perfection. Maybe you're ahead. Maybe you feel behind. Maybe you aren't re-staring at your bank account, wondering how you make decent money but somehow still feel broke. That's normal. These aren't judgments, they're milestones. Think of them as financial checkpoints for your 30s. Let's start with the first, and most important. 1. Eliminate high-interest consumer debt. Not your mortgage, not a low-interest business loan. I'm talking about credit cards, car loans with brutal rates, personal loans from decisions your past self made at 2 a.m. Here's why this matters. The average credit card interest rate in the US is hovering around 20% or more. That means if you're carrying a $10,000 balance, you could be paying $2,000 a year in interest alone. That's not investing. That's reverse investing. If you're paying $800 a month across different debts, that's nearly $10,000 per year that could have been building wealth instead of financing banks. Your 30s are typically your highest income growth decade. According to US labor data, earnings often rise significantly between ages 30 and 45. You don't want that income growth trapped in interest payments. Debt limits flexibility, and flexibility is power in your 30s. 2. Build a 6 to 12-month emergency fund. In your 20s, maybe 3 months was fine. In your 30s, life gets expensive. Mortgage, kids, health costs, aging parents, career transitions. Nearly 60% of Americans can't cover a $1,000 emergency without going into debt. That's not a judgment. It's a reality. But in your 30s, you want insulation. 6 months of core expenses minimum. 12 if you're self-employed or in a volatile industry. This isn't lazy money. This is freedom money. It means you can leave a toxic job. You can survive layoffs. You can handle a major repair without panic. Keep it in a high-yield savings account. Liquid, accessible, earning something, but not invested in volatile assets. You're not trying to grow this money. You're trying to protect your life from chaos. 3. Achieve an excellent credit score, 780 plus. Your credit score in your 30s isn't just a number, it's leverage. Let's say you're buying a $400,000 home. If you qualify for 6.5% versus 7.2%, that difference can cost you tens of thousands of dollars over 30 years. A small percentage difference sounds harmless. Over decades, it's massive. Payment history makes up about 35% of your FICO score. One late payment over 30 days can damage your score significantly and stay on your report for years. The formula isn't complicated. Pay every bill on time. Keep credit utilization under 30%, ideally under 10%. Don't open unnecessary accounts. Don't close old accounts without reason. In your 30s, you're entering your largest borrowing years. Homes, business loans, refinancing. Your score should work for you, not against you. 4. Invest at least 15-20% of your income. This is where your 30s become powerful. If you invest $1,000 per month, starting at 30, and earn an average 8% annual return, you could have around $1.5 to $2 million by your late 60s. Wait until 40 to start? You'll need almost double the monthly contribution to catch up. Time is your biggest multiplier. By 40, a common benchmark is to have 3x your annual salary saved for retirement. So if you earn $80,000, aiming for $240,000 invested by 40 is a strong target. That may sound intimidating, but raises help. Here's the trick. Every time your income increases, increase your investment rate before you upgrade your lifestyle. Automation beats discipline. Turning 30 is a huge milestone, but let's be real, it's also when financial reality hits hard. Suddenly, you're juggling a career, maybe a family, and trying to figure out where all your money's going. First up, let's talk about the silent wealth killer, lifestyle inflation. You get a raise, and what happens? Your spending magically rises to meet it. A nicer car, a bigger apartment, more dinners out. Before you know it, you're earning thousands more but saving the exact same amount. Economists call this lifestyle creep. I call it invisible handcuffs. Here's the rule to break free. Every time you get a raise, at least 50% of that new money goes directly into savings or investments. Do it before you even see it. This one move lets you accelerate your wealth without feeling deprived. Next, it's time for some serious adulting, protecting what you're building. I know insurance and wills aren't exciting, but they are non-negotiable. If anyone depends on your income, you probably need term life insurance. If you have kids or own a home, you need a will and proper coverage. Without these, you're letting the courts decide what happens to your family and your assets. This isn't about fear, it's about taking responsibility. In your 30s, protection is a core part of your wealth building strategy. And if you have kids, let's talk about education planning. College is expensive, with costs easily hitting $25,000 to $70,000 a year. You don't have to fund it all, but starting early is critical. Even just $200 a month in a 529 plan can grow into a significant amount over 15 years, thanks to compound interest and tax advantages. The sooner you start, the less painful it will be later on. Here's one that often gets overlooked. Invest in your health. Healthcare is one of the biggest expenses you'll face in your lifetime, potentially over $300,000 in retirement alone. Your ability to earn money is your greatest asset right now. If your health fails, so does your income potential. Remember, a gym membership is way cheaper than surgery. Sleep is cheaper than burnout. Taking care of yourself now is one of the smartest financial decisions you can make. Finally, you need a blueprint. Random saving isn't enough anymore. In your 30s, it's time to get intentional. You need to know your target retirement age, how your investments are allocated, and what your major life goals are. Whether you create this plan yourself or work with a professional, your money needs to follow a strategy, not your emotions. This is how you build financial confidence, knowing your numbers, your plan, and your next move, so you can handle market swings without panicking. Your 30s are your financial construction zone. It can feel messy and expensive, but the foundation you lay right now will determine whether your future is stable or stressful. The good news? Time is still on your side. You don't need to do everything at once. Just pick one of these points and start there. Small, consistent financial decisions in your 30s don't just add up, they compound. And that, my friends, is how true wealth is built. Thanks for watching, and don't forget to subscribe for more tips on mastering your money.